Welcome to the Daily Update, where I'll go over the action in the market for Monday, June 12th, and then we'll see how things look for Tuesday, June 13th. We had a breakout day. If the market was short and a little bit intermediate term overbought before, well, it's even more so now. But on the positive side, we were finally able to get above 4,300. We opened above that and stayed above that. And then we were also able to exceed the August 2022 high. Those are all pretty positive things. Okay, we're overextended to the upside. Are we due for a pullback? We have some major economic news coming out with the CPI. We have the Fed going to be making their announcement tomorrow. So there's a lot of things to be worried about, but the technical picture is really starting to improve. Before I get started, you'll probably notice I'm back on my regular computer now. I seem to have found a problem that wasn't as complicated as I thought. So I thank you for your patience. And there will be times, possibly, when I do have to use my other machine to record. Thank you for your patience and your feedback. You're not really seeing all that much of a difference anyway. So that gives me some peace of mind. I do have a supplemental video that I posted about a week ago. Talks about protection and hedging. Please feel free to check that out. I do have a PDF that you can download to follow along. I do have a private Facebook group that you're welcome to join. I do have a new poll that is posted. And one of the things I ask in that poll is, do you think the recordings that I did over the weekend were better, worse, or the same? And that's what I'm kind of looking for. I do have videos that I also post on Rumble. They're the same videos that you're watching right now. This is more of a backup. Or you could say YouTube's a backup to Rumble, depending on which site you prefer. All right, let's go back and talk about what happened. We had a positive open. The futures were looking pretty good. We had not really a gap, but at least price above the unchanged level from Friday. We opened above 4,300, and then we stayed above the daily pivot. The daily pivot was at 4,304. As the day went on, we got up to R1 at 43.17. Then we made it up to R2 at 43.35. We closed at the high slightly above R2, so a pretty positive day. We were up 0.93% on below average volume. That's another thing to keep in mind. We are positive with our technicals. We have now entered into a technical definition of a new bull market. We'll have to see where things go from here, but right now, things are looking pretty positive. The market continues to be fixated on inflation and interest rates. What are some comments that we can make? The S&P closed above 4,300 and the August 2022 high. We're seeing what could be FOMO right now, and this often means a short-term top. Sometimes it can even mean a longer-term top. This is fear of missing out. You have folks that didn't believe the market was going to go up. There's a lot of doom and gloom out there. That's why we look at the charts. We try to get our insight based on, okay, I may not feel this way, but the chart is sure saying this. That it separates us from most investors who do it by some kind of intuition or gut feeling. And that produces this fear of missing out. The market's already gone up. The tech sector's been strong. I better jump in too. When they do that to an excessive point, that can produce some kind of a top. Sometimes it could run its course for a while also. The mega caps were strong. The broader market was relatively weak when compared to the mega caps. So we're back to that kind of a scenario again. On a short-term basis, we have the Stochk RSI, the Williams Percent R, the CCI 14 and 20, stochastic, standard deviation. That's been on the list for a while. The CMB Composite Index, that's back on the list, as is the boom indicator. The VIX 9 period, it was off the list. Now it's back on the list. Intermediate term, getting a little bit longer here. The Sean Trend Meter, which has been there a while. The Erin indicator, which this should be the second day now. I just missed that in the previous video. And one part of our PMO study is also starting to look extreme. The dollar was up and interest rates were also up. We have our whole list of yield curves now that are switching back to being inverted again. A few of these had dropped off, the 30 to the 5, the 10 to the 5. They were gone. Now they're back. Sentiment, we're still extreme positive. That's another potential negative thing. We could go higher from here, but at the same time, when people get too exuberant about something, that often means it's run its course. Our trend is still positive and getting stronger. The green line's on top and advancing. Both the ADX and its moving average are going up and they're above 20. I'm still keeping it at mixed to positive for both the bias and the momentum just because there's so many variables right now. It's like we're having a runaway market at this point. We've got CPI, the Fed, all that stuff that's going to be coming out. The market could shift, and it could shift quickly. So just be aware of that. Just because we're going up doesn't mean it's clear sailing all the time. So the economic reports came out very light. Treasury budget, it's a big deal to some, but it doesn't really have that much of an impact on the market. It showed a deficit of $240.3 billion. I know, we all have this little problem that we have to deal with. Last time it was only $66.2 billion. When you look back a year ago, looking at some Isabel Net charts, we have the S&P performance when we're around a narrowing market breadth. This was updated as of June 8th. Right here is where we're at now. We're seeing that breadth and price are really getting close together. It says that the S&P 500 returned around 9 episodes of sharply narrowing market breadth going back to 1980. And this is what Goldman Sachs thinks will happen. They don't really see this as a real warning sign. A lot of people are still getting into money market accounts, and that makes sense. Take it out of your paltry savings account, put it into a money market account where you're getting a more respectable return. Then I'm not going to read through all of this, and this is pretty much old right now. It says years that see a strong Friday are some of the strongest in history, and we showed that in a previous video where currently we're up 101.7%. Now that could change. We could have 10 down Fridays in a row and take this percentage all the way back down. But it just means that Fridays tend to be more positive up to this point. Then we're looking at the earnings per share based on the S&P 500. This is put out by Goldman Sachs, where they're still suggesting that earnings are going to go up, and that could potentially take the S&P up with it. By 2024, they really see an expansion of earnings. And this is where a lot of the justification is coming from. Whether it's fairy tales or fantasy, this is what the market uses to justify, okay, I better buy some more stock. Their earnings are looking a lot better. Then we look at the earnings recession, and they tend to bottom at around minus 16%, which is kind of what we're seeing now. The dark blue line is the earnings that are coming down. They think that will continue to go down to about this 16% level. This is just projection out here before we bounce up and we go up 23% and then fall. For those of you that have been watching my videos for very long, I don't really trust when people put projection lines on charts. I try not to do that myself. I try to point out what's actually happening because you can create any crazy lines that you want to and come up with any justification for it. It doesn't mean it's going to always play out that way, but a lot of people do pay attention to this and they see where earnings are going to decline before they're going to start getting better. But we're seeing other information that contradicts that. Then we see a sharp decline in oil prices. That has historically marked a recession. We are seeing oil coming back down. And if you look at other times, oil was really going up and then a recession, up, a recession. This is contradicting what they're saying in the headline. Up, recession, up, recession. So I don't really understand what they're getting at necessarily. Now, during a recession, oil prices can decline because people can't afford to go anywhere. That can happen overall. And maybe what they're trying to get from this is that since oil prices are declining, maybe it will come out that we might be in a recession right now. Then we look at large cap flows. They peaked at the end of 2022 in December. This is pretty old news right now where we're seeing a lot of shift in this overall market. Then this is also what I'll go over later. This is a ratio between the VIX and the MOVE index. The VIX looks at volatility of stocks. The MOVE index looks at the volatility of bonds. When you take a ratio, they are really going down, showing that there's not a lot of fear. A couple of charts I ran across. This is interesting. If you subscribe to Barron's, their latest, I get it online, but I was able to find the cover. They say, don't fear the bull market. Why stocks are headed higher. This sometimes can be the death of an upward movement. Now, we might have had some happy follow through on Monday, but a lot of times when major financial publications come out, and they suggest this is going to happen, the opposite ends up happening. There are folks out there that use indicators based on magazine covers. Well, since we're all online, it's a little harder to do that. Just as an example, Donald Trump came out with a book years ago talking about the art of the deal and investing in real estate. For that particular time, that marked the top in the real estate market. And a lot of times when you get these books coming out That will mean the top instead of actually something that's going to continue going on. So be aware of that. Then I also found another interesting chart. It says the S&P 500 50-day moving average spread over the last 12 months. It's just suggesting that we're going up pretty far, pretty fast. This was on Twitter. It says the S&P closed 2+ standard deviations above its 50-day moving average, which is similar to a chart that we look at, for 5 straight days recently. Prior times it reached these levels since 2022, which is not all that long ago, it ended up being a short-term peak. Just something to be aware of. Kind of put this on the pile of, yes, we're overbought right now. And then we use other charts to also confirm that. Then looking at the magnitude of historical inversions of the yield curve, we're up at about 49% based on this chart, higher than we've been during other times when the economy ended up going into a recession. Keeping an eye on the Fed. They're going to be making their announcement on Wednesday. Right now, 75.8% chance they're going to leave rates the same. Here's how it's changed. We saw it tick up just a little bit to that they're going to keep them the same. That's the dark blue. And then over here, the dark blue shorter column, it's lessening just a little bit the folks that think they're going to raise rates 25 basis points. Getting into our charts, looking at the intraday chart, kind of a flat open, but it was positive. We opened above the daily pivot, came down, and the daily pivot provided support. We never did go negative, and then we just kind of drifted higher. I was watching this after the open thinking, okay, this is going to be a boring day. We're just going to chop sideways the whole day. Well, we kind of drifted up to R1. That acted as resistance for a while. We got above that. Then later in the day, this is when things really started to take off. We ended up closing above R1. Here's our intraday chart of the SPY, where we look at the evening session that starts really on Sunday, where we did gap higher to start with. Then we saw some weakness, and that fed into the overall positive open. And then here's the climb that we saw during the day, and we're kind of hanging on to those gains now in the initial overnight session. Large cap growth versus large cap value, they're doing about the same right now. On a closing basis, growth did do better than value with the large caps. They were about the same with the mid caps, and they underperformed slightly with the small caps. Here's the intraday chart of growth versus value, showing that growth is making some improvement. So really, we're just kind of coming back to where we were before. Looking at sentiment, no fear going on right now. The VIX actually ticked up a little bit on the line chart as well as the bar chart, which is kind of strange on an up day. The VIX of the VIX, also chopping more or less sideways, but we're seeing a little bit of increase in volatility. Here's the VIX based on 9 periods where we had gone a little bit extreme. Now we're starting to come up out of that. So that actually should have been taken off the list. Then longer term, we're looking at a 253-day simple moving average where this was going up during 2022. Now it's starting to roll over. We're waiting to see, can this line continue to fall? That would suggest that things are turning more positive. Equity put call ratio still continues to fall because we're going up. Looking at the move index where it ticked up just slightly, also the VIX ticked up slightly. Down at the bottom, their relationship is still very strong. Looking at this fear gauge, it is ticking down slightly, and the other fear gauge is also continuing to decline. We're keeping an eye on the skew index. It's in this red area now where they're expecting something kind of big. It could be the CPI. It could be the Fed announcement. There's a whole list of things that could drive the market one way or the other. This chart also suggests that the risk-on posture is continuing. Our advanced decline line study showing some improvement based on price, really seeing a nice improvement based on volume. This keeps going up. It could negate this longer-term negative divergence. We're seeing a little bit of a breakout now with the new highs. That's suggesting that things are getting better. Our 5 period is going up and our 10 period is turning up. The advanced decline ratio above 0 and advancing. Accumulation distribution also positive. Still seeing this longer term negative divergence with the cumulative advanced decline line, but we're seeing some improvement. A little bit of improvement with the regular advanced decline line. We're still above this trend line, which is suggesting there's some improvement for the NYSE. The common stock negative divergence that we're seeing actually ticked down a little bit based on price and was up just a little bit based on volume. We want to see both of these lines really continue to go up, which would take out this negative divergence that we're seeing. Looking at the NYSE, saw a little bit of improvement there because remember on Monday it was the big boys that really took over. So we're not seeing it in a broad sense. The S&P is showing some improvement. turned up slightly with the mid caps and a little bit with the small caps. Looking at our trend, here's the ADX. We're above the moving average and above 20. The green line's on top and advancing, so that is positive. Shorter term, showing the same thing. Volume continues to drop off. You got a lot of the smart money. They're going to kind of hold back right now until they see what's going to come out with CPI and what the Fed's going to do and all that stuff. Short-term analysis. We finally were able to get above the August high and close above that level. That's quite positive. And even though it's right on top of the moving average, it was just a little bit below. Our moving average study showing improvement in the 20, 50, and 200 period study. The boom indicator starting to get extreme again. It could go higher than this, but just something we want to be aware of. The Stochk RSI, the Williams percent R, the CCI 14 and 20 continue to be extreme positive. The stochastics are also extreme with the short, intermediate, and long term. The force index is not extreme and is looking more positive. Intermediate term, we're above the dashed line with the balance of power. The go-no-go system is still positive. The TTM squeeze continues to go up. We're getting back up into the third standard deviation with our standard deviations chart. A little too far, too fast, possibly. The PPO looking good in the long and intermediate term, turning up slightly in the short term. The Erin indicator, when we look at the oscillator down below, which measures the difference between the green line and the red line, we're getting to an extreme positive reading. And other times, if you look up above, this can often mark some kind of a top in the market. Doesn't necessarily mean it comes right away. It just means that we're getting overextended. Looking at the McClellan oscillator for the S&P did show some improvement and above zero, but we actually saw a decline with the NYSE McClellan oscillator. Summation index based on price and volume continued to look more positive, but the summation index based on price and volume for the NYSE, it went up, but is not really breaking out. Swenlin trading oscillator was flat based on price and turned up just a little bit based on volume. That's kind of a warning sign. The PMO is going higher, and we're also going higher based on price and volume. Here's the PMO study that's starting to get extreme positive, where the buy signals are improving, as well as the PMOs that are above zero. The parabolic SAR has the dots underneath. That's positive. We switch back to positive for the Elder Impulse system. The slope is going up, as is the MACD. Looking at all of our oscillators, they are now positive, especially the longer term ones with the Trix and the KST. The Sean trend meter, extreme positive. We showed a little bit of improvement with the BPI, but we want to really see this get some legs behind it, which would mean that it's more of a broad participation in the market. The NYSE bullish percent index is above 50 and advancing, but didn't really break out that much. Chaikin money flow continues to be positive. Chaikin oscillator has turned back up. That's positive. Money flow is turned up and above 50. The vortex is going up with the green line on top. The ultimate oscillator also turned back up. The RSI 9 period is starting to get extreme positive, and we're just under that level with the RSI 14. On balance volume is continuing to be positive. Then we look at our longer range study, looking at the stocks inside the S&P that are above their 200-day moving average. It was pretty much flat. Again, just a few stocks were really driving things higher. Saw a little bit of improvement with those that are above their 50-period moving average. The Copic curve and the Pring bottom fisher are still generating buy signals. We're above this 75% quadrant now at the 170 level, and we're starting to break above other resistance at a previous high. We're getting back up to a full 100% retracement on our short-term Fibonacci chart. And we're coming above this 61.8% retracement on a longer-term chart. And we're also breaking out with the long-term chart. We're above this downtrend channel line. The longer it stays above this, the more positive it will be. Our different charts are all positive across the board. The Heiken Ashi, the Kegi, the Renko, and the 3-line break, all looking good right now. Equal weight index did show a little bit of improvement, but is still underperforming the S&P. The ratio ticked back up when we compare the S&P to the equal weight S&P, showing that bigger stocks had more influence. We're still seeing that longer-term negative divergence between the Dow and the transports, and a shorter-term negative divergence when we look at the utilities. The transports are showing some improvement, but continue to underperform the Dow. The Dow is breaking above this R1 level and showing improvement. The diamonds continue to be positive. The Nasdaq broke above this R1 level, and we're also well above this 50% retracement level. Nasdaq 100 still has some overhead resistance at R1, but has switched back to positive with the elder impulse system. The BPI not really breaking out and not giving us an extreme rating. It just means there's a fewer number of stocks participating. We're above the 61.8% retracement level for the Nasdaq 100. Small caps showing some improvement but aren't really breaking out anymore. That's the negative side. On the positive side, we're still hanging out above this R2 level. Here's the Russell 2000, the RSI coming down after being extreme positive, and it's turned back up a little bit. Looking at this support level, we're not able to break through that yet, but the MACD continues to be positive. The elder impulse system for the small caps is now switched to neutral. The new highs and new lows for the Nasdaq continue to drop off. That's the negative part. When we look at the raw score, we continue to be above zero. The ratio between the small caps and the S&P is starting to go back down, meaning that the S&P is outperforming. But when we look at the small cap ratio between growth and value, it's starting to turn back up. And I added some moving averages here. The blue line is above the red line, so this overall ratio is in a positive trend. The mid caps also just about at the R2 level and giving us now a golden cross. The mid caps for the elder impulse system, however, remain at neutral. We're also seeing an uptrend when we look at mid cap growth versus value, where the blue line is above the red line. Keeping an eye on the robotics AI ETF, since that's all the rage right now. Looking pretty good when you look at this chart, but when you compare it to the tech sector, it actually declined and is pretty much chopping sideways, so it's not outperforming. Keeping an eye on the financial sector, still in an overall downtrend, virtually unchanged. This is a new chart. I just, over the weekend, was just playing around with some different charts. I went all the way back to 2007 and noticed, wait a minute, we stopped right at about here. We broke through it, and that was more positive. And then when we've been coming down, this has been acting as support. So this is a very long-term chart to see, can the financial sector get some legs underneath it and bounce off of this pretty significant support level. Then we look at the financials and compare it to the S&P, and they're turning back down in their performance. The regional banking ETF is also turning back down when compared to the financial sector. Bonds, the yield was up slightly. And it's kind of weird here. We were actually up a little bit based on price. Then the riskier bonds are still continuing to outperform the less risky bonds or the more conservative bonds. Then looking at this, which is giving us a little bit of concern, but we're not quite sure what this means right now. The longer term correlation between the S&P and the long-term bond continue to weaken. The short-term relationship is also weakening. The spread is really far apart. We'll have to see what is happening here. We know the S&P is doing really well. Bonds are doing okay, but not great. So what's going to help to get this relationship back more in order? I'm not really certain about that right now. Then when we compare bonds with the S&P 500 ratio, it shows that bonds are really underperforming. Then we look at the broad range of the stock market and compare it to shorter term bonds. Stocks are breaking out. We look at the tech sector, looking a little further out with bonds, also breaking out. We look at the 1 to 3 month cash, comparing it to the 3 to 7 year bond. This is the concern. This ratio continues to go back up. We want to see this fall. It's not doing that. It's still in a downtrend, but after this death cross, we've seen this ratio really going back up. Then comparing shorter term bonds with longer term bonds, we're just about inside of the rainbow. Then the inverse of that same thing, longer term bonds with shorter term bonds, also kind of at the lower end of the rainbow. Comparing the S&P to bonds, still suggesting that we may see a soft landing. Then, just since I haven't shown this in a while, this is home construction. If the market was concerned that a big part of the U.S. economy, which is building, was going to really come under pressure, this ratio would not be going up. That suggests that things could be more positive than what is being perceived. Then we look at value, which is really underperforming growth, and growth, which is outperforming value. Then here's another newer chart. I take the value to growth ratio, and I do that on purpose because you see the black line, that's the ratio, and we compare it to the red line, which is the 10-year yield, and we see how they tend to go in the same direction from each other, and that's what they're kind of doing right now, and they have a very strong correlated relationship. This is another warning sign. We're seeing the 3-month yield still above where it was at in 2007 before the great financial crisis. Now it's coming down a little bit, but it's still above that level. Our long term, this is also positive longer term. We can barely see it, but the special K is starting to cross above the red line. Can it get above that, stay above that, and then see the red line itself start to turn up? That's what we're waiting to see. An update of our possible positive scenarios. We're still looking okay based on price and volume with our 19-day exponential moving average of the advanced decline ratio. Looking at the Qs compared to the S&P, they're doing quite well, seeing a lot of improvement with discretionary and large cap growth turning up when compared to large cap value. Here we're also seeing an improvement with the large caps, a bit of an improvement with the mid caps, still weak but turning up slightly with the small caps. Then here's a newer chart where the top is the S&P, and I finally labeled it this time. We have some equal weight sector ETFs that we can look at, where the sectors that we usually look at are weighted. So it means the big stocks have more of an influence. On top, we have discretionary equal weight, and that's showing some improvement. Then we compare that to the staples equal weight, another newer ETF that we have available, and that's showing where things are weaker, even though it's still in an uptrend. Then on the bottom, we do a ratio between the two, showing how discretionary is outperforming staples. The S&P to utilities ratio also holding up and giving some support to the market. We're still looking better. We're above zero with our broad range of the 5-period moving average of the highs minus the lows. We're also longer term turning back up with our 50-period exponential moving average of the new highs minus the new lows because the indicator, which is the black line, remains above zero. Then also added a moving average here, looking at S&P growth versus S&P value. That's more for the S&P 500. It's showing some weakness here, but the blue line is on top, so we're still in an overall uptrend. 2-year Treasury yield, not sure this is really helping us all that much right now, but this is helping the market with one caveat that I like to point out. The ratio between the staples and the S&P 500 continues to drop. Other times when that happens, look what the S&P did. Here's the warning sign. When we spiked and started coming back down, the S&P had already had a pretty good run-up. Now it looks like we could be breaking out, but we're very overbought. So what's our outlook for Tuesday? We're still dealing with earnings season. We have quadruple witching that's happening. That'll be on Friday, and that can really produce some really roller coaster runs. The Fed will make a rate decision on Wednesday. That's in the U.S. Europe, those central banks will come out on Thursday, and the Bank of Japan is going to come out on Friday. The technicals are positive. We do have these negative things and these negative divergences that we're seeing in the background, but we are seeing some improvement. We have the NFIB small business optimism. That'll be coming out, as well as CPI. That's the biggie. And then the whole list of geopolitical events, barring something else happening, it's all about inflation and interest rates and what is the Fed going to do. Here's the economic calendar showing for Tuesday CPI. Then on Wednesday we'll have PPI and the Fed will make their announcement. Thursday will be retail sales as well as industrial production and capacity utilization, and we'll get consumer sentiment on Friday. Then we have one scheduled speech this week with members of the Fed. It'll be on Friday early in the morning. Governor Waller is going to Norway to give some kind of a speech. And then looking at the Stock Traders Almanac statistics for Tuesday, June 13th, we're pretty neutral to positive across the board. More than half the time, the Dow, the S&P, and the NASDAQ are up, but not in a real powerful manner. We're on the 9th trading day of the month, where the green dashed line, that's the pre-election year for the S&P, does show some improvement. And then if you're into the NASDAQ part of things, the historical trend has been that it usually lasts until about the mid part of July before we see some pullback. So our scenarios, can't go with the down one. We're not going with that one. We're looking more at the up scenario, but we are quite overbought. And we have a lot of variables out there that the market could justify any kind of reaction. And we're not going with the sideways one right now because our ADX is trending. So our warning signs, the new highs, new lows, they're showing some improvement, but we really want to see that continue to break out on an up day. The BPIs are diverging. Again, it's above 50, so it's getting better, but we want to see that BPI going up, and it's not. A lot of the negative divergences and weaknesses, but there are some improvements that we're seeing. The VIX is still showing that there's no fear. The cumulative new highs and new lows continue to decline even when the NASDAQ is up. The 3-month yield is above its pre-Great Financial Crisis levels. Small caps generated a recent death cross, but they are seeing some improvement, but they're dealing with some overhead resistance. That's the negative side, but on the positive side, they're still hanging on to support. And then earnings season is still here, which can be positive or negative. The positive signs, we have seasonality and setups that are in the background. The long-term special K indicator, it may be switching positive. It takes a lot for this to move, but it is showing some improvement. We've been faked out by this before, so we want to see follow-through with this. The long-term equity put-call ratio, that's that 253 period moving average that I show. It may be turning more positive. It's still starting to come down. The Copic curve and the Pring bottom fisher are both generating buy signals. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture, lower price levels, as well as moving averages, other indexes, Fibonacci levels may provide some kind of support if we start to fall. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100 continue to do quite well. Staples are underperforming the S&P, which gives support to the S&P. The mid-caps are in the process still of generating a golden cross. Small and mid-cap growth is still doing pretty good, even though it's showing some weakness overall. So our conclusion, the S&P, it's still the same. It's positive. We've got some things to worry about, but some of those areas are showing some improvement. In the short term, we're positive, but overbought. Intermediate term, positive, and now we're looking more overbought. Long term, we're still positive because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.